Hi guys, I just want to make a quick video about using market data and position sizing because a couple of you asked in the chat room. But before I jump into that, I just want to talk about a trade that I took on Friday and the trades we had last week. Uh, TLRY was a sympathy play of CGC, but I was thinking when it got rejected at this level, it would crash and goes back. So I was wrong. I had to cut losses. But the other trade I am so proud of is Tesla when I alerted to short it at 375. Unfortunately, because this company has a lot of surprising breaking news, I covered half here at 345 and the rest here at 360, but you see it closed at $303 on Friday. So I made another video about a month and a half or 2 months ago and talked about Tesla, and I said this company is instead of focusing on their product, and the management is started acting crazy, and this is not the type of company can survive in Wall Street environment, because people in Wall Street, they don't care about your product, they don't care about the impact you have on the environment or the goals you are going to achieve or this type of things. They just see the numbers, and if you don't give them good earnings report and cannot fulfill your promise, they short the stock, they kill it, they don't care. So after that video, a couple of people contacted me, or some people commented under that video as well. They said, you don't know the Tesla is a big $1 billion company and this type of things. So, okay, go long and lose all your retirement saving in a company because you don't want. Basically, that's not their problem. They don't know how to invest, and they don't know how stock market works. Uh, as I said, couple of I would say gurus and famous traders in Twitter, they didn't know what to do with Tesla at this level, and they were saying no, don't short Tesla. But we shorted this, we took our profit, similar to Facebook or Netflix that I called a couple of weeks ago. Anyway, I just wanted to mention this because I liked my alert and trade on this, even though I didn't catch the whole move. But if you remember, when I sold half here, I alerted in the chat. I said the rest I would cover. I said sold, sorry. I would cover below 320, which it happened, and you see it went to 300. Anyway, and that was the trade. Let's go back to our main topics. So KYKI asked me, I think it was Tuesday or Wednesday, he asked me about this specific information that now it's available to public by Nasdaq. It's net order imbalance indicator. So you can pay $15 per month. You get access to this, and uh, depend on your trading system, it can add some value to your trading. But if you just started and you are just want to know what's going on. This is not a specific uh, market information that you need to pay that $15 per month. So uh, they have a instruction for how to use this. Basically, net order imbalance indicator tells you the imbalance shares that are sitting at some side of the uh, booking orders, and market makers, the only job they have to do is to bring liquidity to the market. They basically they call it market maker, so it means they have to create a market. So they had access to this information before. Now Nasdaq give access to the public to this information. So the important thing about these columns is paired shares, imbalanced shares, and imbalanced side. So paired shares are the total number of shares that are eligible to be matched at the current reference price. Reference price, they mentioned in this instruction what is current reference price, but think it's the price of the price that are trading now. So imbalanced shares are the difference between the shares that are basically sitting there for sale or sitting some price below the reference price to buy. So imbalance side tells you which side is basically created this imbalance. For example, when it shows B, it says the buy side has this imbalance. So it means there are more shares sitting in the buy. Let me see if I can, for example, show you here in the market depths. In the market depths, you see, for example, there are some bids sitting here, but you don't know how many, how big are the bids, for example, sitting at 300 or 295, and you don't see how big of the orders sitting in a price in the ask side in $304. You see this number, but you don't see the depths of these. So basically, net order imbalance indicator gives you this information. And for example, if you are a big short seller, when you see there are imbalance in the sell side, you guess, okay, the market makers try to bring those orders to the market because they are money sitting somewhere, liquidity is accumulated in a specific price, so they start to bring the price close to that a specific price to unlock those liquidity. So as I said, it depends on other factors, like for example the news in the stock is important, the previous resistance, all of these things hands together plus this, for example, information can help your trading system. But you have to first understand, does it really help my trading system, or It's just something that they charge me $15 per month, and I really cannot use it. So, because I am a fan of make everything simple, and if you know me and you were in the chat past few months, you know I don't like to add complexity to my trading systems. Either it's long term or short term, swing trade, long, short, whatever. So I posted this uh, picture in Daily Stock Money Instagram exactly on that day. I think it was, I don't know, it was Wednesday, whenever. It's from Jesse Livermore. Jesse Livermore was a trader in 1900, I guess. Uh, so he made millions of dollars on that time, early years of the stock market, and he was very famous. And for those of you who don't know Jesse Livermore, I brought you these two books, Reminiscence of the Stock Operator. People say this is the biography or the story of Jesse Livermore. And there is another book by How to Trade in Stocks, Jesse Livermore. If you want to be a trader, sooner or later you need to read these two books. So anytime you had spare time, go to the library and borrow these books or buy it from Amazon, wherever. These are very helpful. So Jesse Livermore said everything you need to know is right there in front of you. If you want to trade, I don't know, futures, contracts, options, stock, whatever you want. He says, don't make things basically complicated for yourself, because whatever you need to know is exactly in front of you. You just need to have discipline and some trading system that works for you, and some very clear set of rules that basically protects you when the trade doesn't work. So for that reason, I by the way, go to our Instagram and just follow our Instagram page. I post a couple of pictures every now and then. It's fun. So let's go back to the things I wanted to talk about market data. So let me do this. We don't need that, and we'll start from here. Okay. I just wanted to I searched my notes and I found a couple of interesting points that I wrote before. I wanted to share with you here to back my claim. So this guy was, I think it was George. Sorry, George Andrella. He was a French economist, and he did some study about the rate of changes in the information that we have these past years. So he found out in 1500 years from the time of Jesus to Da Vinci, the rate of the information that human being needs to uh, um, basically understand and deal with basically doubled. And then after 250 years after that, it doubled again. 150 years after that, it doubled again. 5 years during the computer age, the amount of information you need to consider as a human being is doubled. And this article was published in 1980, 19, no, 1990 something. So you can go and read this. It's interesting article. But what they said was the amount of data you need to process is doubling maybe every year. So have that in mind. If you want to know how your brain can process visual data, there is another article in MIT. You can go and read that. The point is, your brain can just take 1 or 2% of the visual information that goes to your brain in any one time. It can be 1 second or few seconds, and then your brain can just process 5 to 9 chunks of information at any time. Chunks of information means basically it can be somewhere between 2 digits, any type of bits if you want to use the unit, but it can be this number or this number. This is a chunk, this is a chunk. So for your brain to process all of this information, it's kind of impossible. For people who are working in Wall Street, because every day there are some market opens in another time and some news happens every day somewhere around the world. These guys, they have to fully function and process all this information. So that's the reason they use cocaine and other type of drugs, to just be conscious and process all of this information and the impact on the market and their position and portfolio or whatever. So for us, for retail traders who are not dealing with big positions or all the different type of assets, bonds, or I don't know, commodities, whatever, futures, we are personally, I just like to focus on companies, stock, and make it simple. So adding different type of information to my trading system, it just makes everything complicated. And if you read this sentence, what your brain does when you want to make a decision, basically your brain generalize and delete most of the information. So don't think by making your trading system complicated, adding too many market data and too many information to make it simple decision. It doesn't improve your I would say profit, or doesn't improve your trading plans. So I just wanted to share this with you, and mm, for those who probably wanted to get these services, I just want to tell you first think about your trading system, and if it's something that really fits into your system and really can help you, go and add this to your uh, basically platform or system, whatever you want to call it. They have different types of information that they really some of these you're already have it in your platform, but as I said, don't pay extra amount of money because people say, yeah, I use this and it gives me an edge. So this is not like that. So let's go back to the second topic. Sorry, I talked a lot. So position sizing, money management, and asset allocation. Usually, when you want to learn about position sizing, you see a couple of books about money management and asset allocation. Money management is, as I said here as a note, usually this is a heads up. If you see a book and you start reading and you see they are talking about when to get out of the trade or take profit or exit strategies, this is not position sizing. This is basically exit strategies. So an asset allocation usually by portfolio managers, they want to know how much of their capital devoted to stocks, bonds, or whatever assets they have. So what is position sizing? Position sizing basically tells you how much throughout the course of a trade. It means you are going to a trade and you want to know how much should be your position, how much you should invest. So this is the shocking part for most of you if you haven't heard about this. My guess is nobody talks about this stuff because they don't know it, or uh, they don't want you to know, whatever. So position sizing. Oh, I started with the Ralph Wings experience. Oh, let me share with you. I have this uh, books. Just wait for it. I have these books in case you want to learn about position sizing. Um, William Ziemba, The Adventures of a Modern Renaissance Academic and Investing in Gambling. The Mathematics of Money Management Research Analysis by Ralph Wins, which I'm going to give you one of the examples he used in his book. Van Tarp Definitive Guide. This is one of the good books about position sizing. He has another one, yeah, Trade Your Way to Financial Freedom by Van Tarp, and another book by William Ziemba, Beat the Racetrack. Yeah, I think that was it. And the first one, yeah, it's the same. So now you have these books. In case you had time, go to library and borrow and start uh, read this book. So Ralph Fiennes, he performed an experience. He asked 40 PhD graduate students with $1,000 to each one, asked them to play a game, and he told them uh, you have 100 trials uh, to, for example, push this button or whatever. 60% of the time you get the winning result and 40% losing result. So, and by betting any percentage of this initial capital, if you win or lose, you get exactly what they risk per trial. So, for example, imagine the game is the Philippine coins, and but they designed the computer in order to give you 60% winning result, 40% losing result. So you just need to invest uh, the amount of money from this $1,000 and push the button for 100 times and see how much you can win. Even though they had a 60% win ratio, 5% came out with more than their original starting balance. 38% of these PhD graduates, they lost their money. Probably you are thinking about 5% winner, 95% loser. So I push that here. Does this ratio familiar? 5% successful, 95% unsuccessful. You might heard this ratio for day traders. They say 5% of day traders they make money, 95% they lose money every single day. So now I want to tell you what's the secret that created this ratio. The problem with all of these losers was position sizing. Everything was the same. Even the ratio of winning, they told them, you win 60% of these 100 times. But they lost. They lost money. So I had a video before and I talked about how loss works geometrically against you. And for example, if you lose to 20%, you need 25% gain to go back to break even. If you lose 50%, you need 100% gain. If you lose 75% of your capital, you need 300% gain to go break even. So, probably all of these 38 people who lost their money, they were somewhere around here. So, now I want to give you another example about what's the problem. What's the problem? People think the problem is basically in the position sizing, but after hours and hours of studying, I finally want to tell you the problem is not in this side of the story. Yeah, if you know how to position size, uh, it's the secret. But the main problem is you are doing this game over and over and over again. You are doing 100 times. So coin flip is a good example. If I tell you we just flip a coin, tail wins, the other you lose, and you have, for example, $20. If you win, I double that. If you lose, I take that $20. So, but we just want to do this once. Uh, what would be the best uh, investment? Basically, what would be the best position size for you? The best position size for you is 100% of your money. If you bet that $20, because you have just one shot, if you win, you double that. But if I tell you we want to do this game 10 times, even for the second time, for this, when I give you a second option, there is another opportunity that you have. So logically, you start thinking, okay, if I lose my first initial investment in the first attempt, I have to have another uh, piece of my capital because I have another shot. You have two shots. And if I say you have 10 shots or 100 shots, or in trading, you have infinite shots. You can trade as long as you live. So now your best position size is not 100%. It's not even 80%. It's not even 50%. Your best position size has a relation with the number of trials or attempts that you have. So let's go a little bit further. I described all the strategies for position sizing, and at the end I want to tell you what is the best that you can choose, especially for day traders with a smaller account. So you might heard about martingale strategy. It says increase your bet size when basically you lose. Um, if you played roulette or craps uh, with infinite account size, this is the best strategy for you. It says if you lose $1, the next time double your equity, double your position size. Bet $2. If you lose $2, bet $4. If you lose $4, bet $8. You need infinite account size, and you will definitely win in these two games, because once you win, you immediately go back to break even, and you can at some point you can build a big stack and make a lot of money. But for uh, trading strategies in the stock market, anti-martingale strategy is the best. Those books from William T. Ziemba, uh, they explain these two strategies and why in the stock market you have to use anti-martingale strategy. Basically, you increase your position during your winning streaks. So here, no, it was this the other one. Anyway, I told you which book explained this first. Now you can go and read this if you are interested. So, strategies for the stock market. We have a spectrum of different strategies. Warren Buffett strategies and William O'Neill, the book that this is the name of the strategy. The book that I introduced you last time, he explained his strategy, this is the name of the strategy. Basically, he was saying if you have a very big account, millions of dollars, um, it's good to have seven, nine, not more than 10 different stocks in your portfolio. And if you have a smaller account, it's better to have just one or two stocks in your portfolio. So I explain this strategy in more details later, but let me talk about Warren Buffett's strategy. Warren Buffett's strategy is the extremest position sizing strategy you can find. He finds a company that he believes this company is undervalued and it has huge potential in the future, and he starts to buy as much as he can, and he doesn't have any plan to sell those shares. He just buy whatever he can from that company, and he wants to hold them forever. This is his strategy, and he is very successful. If some people want to follow uh, this strategy, let me know. I give you a couple of books that help you to define the criteria that specifically this person uses to find those companies. And if they meet his criteria, he buys those shares as long as he can. But there are some other strategies in between that I think it's very helpful to you guys with a smaller account. So, some people say money management stop. This is one strategy for position sizing. Some of the traders they call it oh shit moment. For example, they say $1,000 is the oh shit moment for my trading system, or $10,000, or $5,000, whatever they depend on your account. Basically, their own strategy for position sizing is they go into the trade and until they didn't lose $5,000 or $1,000, whatever. It's a well-defined number based on their trading account, and they say this is the number. After this, I cut losses, and my position depends on this amount of loss. So the problem is it doesn't give you the information how much you need to invest. Position sizing, as you remember, I said position sizing is about how much you have to invest during one trade. So, oops, I passed it. So it doesn't tell you how much. Then another strategy is fixed amount of money. For future contracts trader, basically for future traders, they define one unit for fixed amount of money. For example, they say $20,000 for one contract, and they don't go to the second contract unless they have another $20,000 that they can put aside for that uh, trade. So basically, the problem with this is it just limits you to the amount of money you set aside for a specific trade and um, doesn't help you to increase your exposure. For example, if you see there is a better opportunity and if you can buy more because that's part of your trading system, that's part of the rule of your trading system, you cannot increase your exposure. And the problem, main problem is you are unable to uh, choose between different trades because you trade based on fixed amount of money. This is your position, $20,000, 1 unit. And it doesn't give you a better understanding about your risk because it's just about the fixed amount of money and 1 unit. For traders, they do the same, sometimes they do the same thing. Their position sizing system is, for example, I have $1,000 for Tesla, $1,000 for trading Tesla, and it's 2 units at $300. And if the trade goes in basically based on the plan, the next time they want to increase their exposure is another $1,000 for buying another 2 shares of Tesla. But the problem is they think they have to make that $1,000 profit first to invest in Tesla because you defined the fixed amount of money that you are going to take as a position for each unit of your equity. Anyway, this is not a good, especially for a smaller account, it's not a good way of position sizing. So the next model is percent risk model. They define the percentage of risk that you want to take in each trade, and based on that you calculate your position size. So the cash that you are okay to lose is the amount of basically percentage of your total capital that you are okay to lose that. You cannot say, for example, I'm okay to lose that 10% of my capital or 20% of my capital because it's against those rules that I mentioned in the previous video about losses. If you lose 25% of your capital, or you say I'm okay to lose 30%, 25% of, you need to make, for example, 45% gain to go back to break even. So you cannot say I have $10,000 and I'm okay to lose $4,000 because it's, by definition, it's against the rules for being profitable trader. This amount is somewhere between 1 to 3% of your main capital. So if you have $10,000, you can lose 1% of that. You can lose $100. So now you are going to a trade that, based on the chart and those things you are seeing in the chart, you defined your risk per share in that specific trade. Then dividing this number by risk per share, it gives you a position size. We go to example. So Yeah, I said here, what is cash percentage of your total? Yeah, shouldn't be more than 8% for a small account. So example, you see this chart, and for example, you know this is the resistance, this is the support, and the stock is trading around here. $50 now is the price. Some people call this ABCD or something like that. So you are at $50 and you think, okay, if it drops to 48, I can tolerate that. And 48 needs to hold, or if it doesn't hold, I immediately sell and get out of the trade. But I think the risk here is $2 per share. Then let's say what's going on. Okay, let's say you get into the trade with the hope of it tests the resistance again. $10 upside, $2 downside, seems good. So how much I should buy? That's the secret. The secret sauce to take these type of trades over and over and over again and make a lot of money. The secret is how many of these shares you have to buy. So let's say you have $50,000 account. Your total risk is 1%. As I said here, your total risk shouldn't even touch 8%. Make it 5%. Because if you lose 5%, you need 5.3% to go back to break even. But let's say you take 1% of this 50K is $500. $500 is this cash that you are okay to risk in this trade. Risk of this trade per share was $2. 500 over 2, it gives you 250 shares. 250 shares multiplied by 50, you take 12, 500, basically investment, total investment in this trade. You have $50,000 in your account, but in order for you to take these type of trades over and over and over again, with some cases that it doesn't go to 60 and it crash, with some cases that it goes to 60 and goes above 60, for you to be consistently profitable after infinite times of betting in this type of trades, you need to invest by this size. If you invest $30,000, you are risking more than $500 if it drops $2, which means you are risking more than 1% of your total capital. So this is a good formula for you to understand what should be your size here. So let's take another example. This is another trade, but it's more expensive stock, $140. So you say, I think you are here and you think, okay, there are two types of risk per share. If it drops to 139, I'm risking $1 per share. Or if it drops to 137, I'm risking $4 a share because it was the previous support, and I think it's good. It can hold this. Or you think you are here and you think, okay, the previous support was 139. I want to take this risk instead of this risk. So you have two different position size for these two. And for this example, let's take 2.5% of your main capital as your risk instead of 1%. Okay, 2.5% of your main capital is $1,250. For the case of $4 drop, you have 1,250 over 4. You buy 312 shares. Multiply by the price of the stock. Oh, it was 140. Multiply by 140. You are investing $43,000. It's over 80% of your account. Your account was 50K, and you increased your risk, and the stock that you are buying is higher price, and you see you are investing $43,000 of your investment. So your total investment has nothing to do with your initial risk. With this. So for the other case that you are risking $1 per share, for example, you say, okay, I want to buy this stock and I just want to hold it in case it just dropped to $1. After that, I want to get out. You still want to risk $1,250. So 1,250 over $1 risk per share, it would be 1,250 shares. 1,250 multiplied by 140 is $176,000. So you had just 50K in your account. So if you want to risk this amount with this price, with the hope of this goes to 170 over, the position size is out of your even marginable side of your account. It's 3 times of your cash. So basically, when you are in this type of situations, you should say, it's not the trade, even though it's a nice chart that you can read and you know, but based on these factors, you cannot take this trade. It's impossible. So it's a very good strategy for, as I said, large and a small account. They can basically build up their account, and they can equalize performance in, if you are, for example, buying 3 types of stocks in your account, by using these position size systems. As I said, you cannot buy this. This is out of your capacity to get into a trade like this, even with $1 drop in $140, because the position sizing, optimized position sizing tells you you have to invest $176,000 6K, which is impossible. So you don't take these trades, then you start to work on a trade that gives you the best position that you feel comfortable to go with. Because when you invest, for example, in the first example, when you invest $43,000 with $4 drop to this level, you are still having some cost opportunity for investing this, because it's 80% of your account. You cannot invest in anything else. Okay, guys, I am so tired and I cannot talk more than this. I decided to cut the rest of the video and just finish it with this to tell you these are the methods for calculating your position size. The takeaway is don't risk too much money on any position due to unknown timing and length or losing a strike. When you are not comfortable, it means, oh, come on, see, I cannot even type. It means you are in too big. So reduce your position, reduce the level of your stress. With a smaller account, you don't need to just take these calculations every time, but it's better to understand these calculations, and you can manage your position easily and build up your account and go to the next level of trading and use this type of methods. So as you probably understand and you hear it in my voice, this took me a lot of time to put all this together. I had to go through all my notes and find these books and pages and just even copying and pasting here. It took me a lot of time, so I appreciate it if you subscribe to this channel and share it with your friends and gives it a thumbs up. And I promise you, if we get 100 subscribers in the channel, I will make a video and reveal another secret in trading system that really helps everybody who are trading with a smaller account. Let's see how many subscribers and likes do we get after this video. See you everybody in the chat room tomorrow. Have a good one. Bye. Oh, sorry, by the way, I'm traveling tomorrow and Tuesday. Sorry, I cannot be in the chat room all day tomorrow. I just might say hi and during the day just check a couple of stocks, but I won't be able to be there all day. Good luck, good luck, good luck. Stay safe and don't force any trade. See you. Bye.